Have you ever found yourself just staring at the charts, feeling like the market is just going nowhere, just chopping back and forth with absolutely no clear direction? Or maybe you've wondered, how do the big funds, the smart money, always seem to catch those massive long-term trends? Well, believe it or not, there's actually a secret language the market speaks, and it all comes down to the relationship between two really key instruments. So let's dive in and decode this thing together.
Welcome to AI Explains ICT. In this video, we're going to be covering the core content from Month 5, Episode 6. You're probably going to want to grab a pen and paper for this one because we are about to unpack a really powerful analytical concept that could totally change how you see the market. All right, so here's the game plan. First, we're going to talk about the big problem all traders face. Then, we'll get into the nuts and bolts of what we call the price versus yield dance. After that, we'll look at how things are supposed to work with seasonal patterns. And then comes the really cool part. We'll see what it means when markets move together and what it means when they move apart. And finally, we'll wrap it all up into a simple framework you can start using right away. Okay, let's just get right to the heart of it. I think the biggest challenge for anyone looking at the higher time frames is trying to figure out, what is the market trying to do right now? This is it. This is the million-dollar question, isn't it? Is the market gearing up for a huge move where you can just jump in and ride a trend for weeks, maybe even months? Or is it setting up a nasty, choppy range that's just going to chew up accounts? Answering this one question correctly is, honestly, the key to unlocking long-term consistency. So to answer that big question, we have to first understand a really fundamental relationship in the bond market. I like to call it the price versus yield dance. This little concept right here is the engine that drives everything else we're about to talk about. Here's the most crucial piece of the puzzle. The price you see on a chart for a 10-year Treasury note or T-note, it moves in the exact opposite direction of its yield. Think of it like a seesaw. It's an inversion. So if the price of the T-note is falling, its yield, or the interest it pays, is actually rising. And if the price is rallying high, the yield is falling low. It's that simple, but it is absolutely critical you get this. Now, here's where it gets really, really interesting. This whole dance directly impacts the US dollar. See, big institutional money, we're talking long-term funds, they are always chasing yield. So when that T-note price drops, what happens? The yield goes up. Higher interest rates make the US dollar way more attractive to own, so money flows in and the dollar gets bullish. And on the flip side, when the T-note price rises, its yield falls, making the dollar less attractive, which is, you guessed it, bearish for the dollar. Okay, so now that we've got the mechanics down, let's establish a baseline. Every market has its own rhythm, its own seasonal tendencies. And by looking at the typical yearly cycles of T-notes in the dollar, we can get a really clear picture of what normal behavior is supposed to look like. Let's start with the 10-year T-note. If you look at this seasonal chart here, you can see a very obvious pattern. The price tends to fall for the first half of the year, usually finding a bottom somewhere around June or July. And once that low is in place, it typically stages a really nice, strong rally for the rest of the year. This is its dominant yearly cycle. Okay, now let's switch gears and look at the US dollar index. What do you see here? It's basically a mirror image. The dollar has a strong tendency to find a major peak right around that same June to July timeframe, and then it trades lower for the second half of the year. It's almost a perfect opposite of the T-note seasonal pattern. And looking at them side by side like this, it just brilliantly illustrates the market's normal state of being. The relationship is just undeniable, right? T-notes on the left bottom and rally after June. The dollar on the right tops and falls after June. This inverse relationship, this is the default setting. This is what's supposed to happen. And when it does, it signals one type of market. But when it doesn't, well, that's when things get really interesting. All right, let's jump into our first major scenario. We're going to look at what it means when this normal, inverse relationship just completely breaks down, and these two giants decide to walk hand in hand in the same direction. So what is that telling us? As analysts, if the markets are breaking their own long-standing rules and moving in tandem, what's the hidden message there? What is that telling us about the health and the true direction of the broader market? So let's take a look at this example from back in mid-2016. On the left, we've got the T-note chart. And just like its seasonal tendency told us, it put in a low around June and started to rally. But look over at the dollar on the right. Instead of falling like it's supposed to, it also rallied. They were moving in lockstep. This is a huge red flag that something is off in the market. And here is the key takeaway. Write this down.
When T-notes and the dollar are moving in the same direction, it is a massive signal for large-scale consolidation. It's a sign of long-term indecisiveness. Neither the buyers nor the sellers have control, and the market is very likely to be choppy and just stuck in a range. This is not the environment for long-term trend following. Now for the other side of the coin, this is the scenario we get excited about. This is the one that signals that powerful, explosive moves are just around the corner. This is when the markets get back in sync with their natural, opposing relationship. So check out what happened just a few months later, in late 2016. On the left, the T-note chart shows a massive trending sell-off. I mean, prices are just falling off a cliff. Now look at the dollar on the right. It is doing the exact opposite. It's staging a powerful, one-sided, screaming rally. This right here, this is that classic inverse relationship we talked about, but it's on steroids. And this is the green light. This is what you're looking for. When you see T-notes and the dollar moving in clear, direct opposition like this, it is signaling a strong, trending environment. This is when the large funds are active, they're placing huge amounts of capital behind one directional bias. These are the periods that create those long-lasting trends that can go on for weeks, sometimes even months. Okay, so we've covered the theory, we've covered the mechanics, and the two key scenarios. Now, let's boil all of this down into a simple, repeatable framework that you can start using in your own analysis, like today. Here it is, a simple 4-step process. Step 1, always start by analyzing the 10-year T-note and its seasonal tendency. Where is it in its yearly cycle? Step 2, compare its actual price action to the price action of the dollar index. Step 3, and this is the most important part, determine if they are moving together, in tandem, or if they are moving in opposition. And finally, step 4, based on that one observation, you can formulate your high-level market bias. Are we likely in for a choppy range, or are we in a long-term trending environment? And this quote from ICT just perfectly summarizes the most powerful takeaway from this entire video. The highest probability setups for major, long-term trends happen when that T-note seasonal tendency is working like it should, and it's confirmed by the dollar moving in the opposite direction. That is the signature of a healthy trending market. So I'll leave you with this question. Now that you can read the secret language between the T-notes and the dollar, go pull up the charts for yourself. Compare them. Which environment do you think we're in right now? Are we in a consolidation, or is there a brand new trend just waiting to unfold? I really hope this framework gives you a whole new level of clarity in your analysis. If it did, please like this video and subscribe to the channel for more content just like this. And if you have any questions at all, just leave them down in the comments below, and a human will get back to you. Safe trading.